I personally am a huge fan of higher yielding ETFs, and this is as long as they would be considered higher quality high yielding ETFs. Now let's be real here, there's tons of higher yielding stocks and ETFs across the market that are absolute junk, but there are a select few that have been tested throughout time and have all come back with great performance, at least as of so far. Now in this video, I'm going to go through some of my favorite higher yielding ETFs across the entire market that I would consider not only safe, but higher quality, and this is due to several different aspects. Now every single higher yielding ETF that we're going to go through are all ETFs that you can actually find throughout my long-term portfolio, and I personally like to utilize these sort of assets to raise the amount of dividend incomes that I earn on a monthly basis, which just as of recently has surpassed $6,500 per month on average. So if you want to see every single higher yielding ETF that more or less crosses through what I would consider high quality high yielding ETFs, make sure to stick around, drop a like down below, and let's go through the very first one. The NEOS S&P 500 High Income ETF, or ticker symbol SPYI, aims to offer high monthly income in a tax efficient manner with the potential for upside capture in rising markets. Now some of the objectives are to seek high monthly income in a tax efficient manner, and also on top of that have upside potential when the market turns bullish. Now this is also kind of cool. It shows that since inception, the NEOS S&P 500 Income ETF, or SPYI, has outperformed some of the largest income-focused ETF peers, and some of these are very popular. And just for full transparency, I personally hold everything in here. So you can see that the blue is total returns. This is dividends plus price return included. SPYI almost has a 20% total return, where XYLD has over 12%, JEPI has 16%, Devo has almost 16%, and SPYI, of course, the king of all ETFs, has almost 30%. Now, if you've been watching me for a while, you know I've talked about SPYI in the past, and I have had a few shares of SPYI across my portfolios for several months now, but it wasn't until recently I dug a little bit deeper into this ETF and really realized how this ETF works and why I personally need to add more shares of SPYI into my portfolio. But digging a little bit deeper into this ETF, some of the negatives, I guess you could say, is the expense ratio is pretty pricey. At 0.68%, this ETF, because it's management heavy, is going to cost you a little bit more to hold on to. But with the promising total return so far, at least, the expense ratio doesn't bother me all that much. Now, one of the other reasons I wasn't exactly sure about how much SPYI I wanted to add to my portfolio long term is because a lot of these higher yielding ETFs, although many times offer nice juicy dividends, they seem to decay in price over time, meaning that, for example, if you buy a share for $50, even if it pays a 10, 11, 12% dividend yield, if a year later the ETF is trading at $40 per share, you didn't really gain anything. If anything, you lost money. But so far, since around 2022 at least, so keep in mind this ETF still is relatively new, the ETF is up 3.33%, which I hear you, it's not all that much, but it is in the green, and we haven't seen any major decay, at least as of so far. QQQI, or the NEOS Nasdaq 100 High Income ETF. Now, not to be mistaken with SPYI, which is another income-focused ETF that NEOS offers, QQQI focuses on the Nasdaq 100. Now, digging right into it, this fund's inception date was 1/30/2024, so this fund has only been around for a matter of days at this point. But the fund strategy is pretty simple and straightforward. It says, number one, the fund seeks to distribute high monthly income generated from investing in the constituents of the Nasdaq 100 index and implementing a data-driven call option strategy. So a lot of covered call ETFs have an underlying focus that they sort of track or reference to, or of course invest directly into. QQQI is focusing on the Nasdaq 100 and using that index to sell covered calls on, which isn't really groundbreaking or anything that crazy, but just wait, it gets better. So it says number two, actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing NDX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. So what I've found great about NEOS overall since I sort of came across NEOS a while back, at least with SPYI and now QQQI, they're really trying to take a different angle, a different approach, and trying to make some of these more income-focused, cover call style focused ETFs a little bit more tax efficient, which by utilizing 1256 contracts, this ETF could have a much better tax treatment than some other similar funds out there that have a similar strategy that QQQI has. So far it seems pretty straightforward and pretty positive. By utilizing the Nasdaq 100 and implementing a data-driven cover call strategy, also along with that being very tax conscious, and of course trying to get this ETF to be the most tax efficient as possible, so far so good. But lastly, number three, it says the fund utilizes a call option strategy that may include both sold and purchased NDX index options. which may provide the opportunity for upside capture in rising equity markets. So if you're familiar with the way options work and this fund strategy, you're probably looking at this and thinking to yourself, wow, that's an incredible idea. Because basically what NEOS is trying to do is they're trying to sell covered calls and earn a ton of premium for doing so, which then of course will be paid out to investors like you and I. But also, this is very, very important. During times, the management of this ETF is also going to be purchasing NDX options. Now, it's no secret that Nasdaq 100 can be pretty high beta, so during crazy times, the market NDX could see a massive influx. And generally speaking, at least, selling cover calls on the Nasdaq 100 is going to give you a capped upside potential. But because this ETF is specifically looking to also purchase NDX options, that means this ETF could also have some massive upside potential if the market trades a certain way within a certain time frame. Now, I personally like that a lot, and that's one of the main reasons that I haven't been as fond of some of the covered call style, income style ETFs, say over the last year or so, just because they don't really have all that much upside potential in my eyes, even though there are certain ones like JEPQ that has grown a ton in the last year or so. But the fact that QQQI is also going to be possibly purchasing NDX index options over time makes me really like this ETF, just because at least in theory, this ETF is going to have upside potential even with the overall cover call strategy. Now it says right here, front and center, reasons to consider QYLD as an investment. It says high income potential, which is again one of the main reasons and why I got interested in purchasing QYLD off the bat. It says QYLD seeks to generate income through cover call writing, which historically produces higher yields during periods of volatility. And we're going to talk a little bit more about that cover call writing in a second here. Now also QYLD does have monthly distributions and has made monthly distributions for 10 years without missing a single distribution. Now the monthly distributions, monthly dividends are also important to those dividend income focused investors like myself, because at least speaking for me personally, I like to get monthly distributions currently to reinvest that cash balance into more different dividend paying ETFs and stocks to really start the compounding snowball effect for my portfolio. But later on in my life, I want to have monthly distributions to help cover bills or just everyday life expenses. It also says efficient option execution. QYLD writes call options on the Nasdaq 100 index, saving investors time and potential expense of doing so individually. Now this sort of cancels out one of the main criticisms of some of these covered call ETFs. A lot of investors say, well, why would you invest into a covered call ETF like QYLD, like JEPI, or like anything of the sorts when these ETFs do charge an expense ratio, like QYLD for example is 0.6%, when you could of course just buy the underlying assets and then write your own covered calls into yourself. And although that is good criticism, it's a lot easier just to buy a share at a time, especially for investors that might not have that much money, because buying directly into some of these indexes can get pretty expensive. But that does bring me into my next key point when it comes to QYLD. It does have a 0.6% expense ratio, which is pretty expensive considering if you're going to compare QYLD to some of the more index-based ETFs like VOO, or of course SPYI, they're not going to charge you even close to as much of an expense ratio. But keep in mind, because this ETF does have the cover call overlay, it is going to be a little bit more management intensive, which in turn you're going to have to pay for at least a little bit more. Now the net assets are currently around 8 billion, so this is one of the largest cover call style ETFs across the entire market, at least to my knowledge. So now looking into the holdings of QYLD. Like we talked about, QYLD does invest into the Nasdaq 100 index. So by buying into QYLD, you're going to have direct exposure to names like Microsoft, Apple, Amazon, Nvidia, all these high performing technology names like you see right here. But along with that, you also see that there is an upside cap, which means because this ETF also shorts the Nasdaq, specifically by using a cover call option, this ETF is basically buying into all these assets and then also shorting them at the same time, which does a number of various things. For one, it caps the upside potential. So if these names are going to rocket within the time frame of this option, which as right here, you can see the expiration date is coming up pretty soon here. Well, then in that case, the upside is going to be capped because a cover call only has an infinite amount of gain. In this case, the strike price is right here. Now, during this time frame, if these names were to go down, let's say, the short Nasdaq call option would of course help, because by selling a covered call, you're generating premium, which in turn is helping against downside protection. Now, I say all this just to say that if you want direct exposure to some of these top holdings within this list right here, names like Microsoft, Apple, Amazon, Nvidia, etc., and if you do not want to have a capped upside, well then buying into QYLD might not be the best option. But if you want to have exposure to these names with a cover call strategy that's generating a ton of premium on a monthly basis, well then QYLD might be your exact ticket. So first, for some of the newer investors out there, JEPI is a cover call option income style ETF that, like we sort of mentioned, buys into a basket of holdings and then also sells cover calls within the portfolio. Now, to be more specific on the actual JPMorgan website, it says right here, seeking consistent premium income with lower volatility. It says JPMorgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure with less volatility, which a lot of us more slow and steady income focused investors definitely don't mind at all. Now, the portfolio is basically an offensive equity portfolio, employed a time-tested bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock rankings. But then along with that in the portfolio, there's a disciplined option overlay, implementing written out-of-the-money covered calls on the S&P 500 index to help generate those juicy dividends, that monthly distributable income. Now, also very important when it comes to JEPI, I mentioned earlier that this fund, this ETF, is extremely popular with over $33 billion in AUM. Also very important to mention, this ETF does have a 0.35% expense ratio, so it is going to be a little bit more expensive to own than other index funds across the market, but that's of course because we went over exactly how this ETF works and the fact that it is more actively managed than other ETFs across the board. Now, to try to figure out if this ETF is all hype or if this ETF is actually all it's cracked up to be and worth investing into, looking at this ETF's performance over multiple time frames, and keep in mind this is just price performance, we're going to look at dividends and total return in a second here. But just as far as price performance, how JEPI's been trading over the last year, it's up 8.52% as far as share price goes, and that's not bad at all considering this ETF does have a generally higher than average starting yield. But on the max time frame, JEPI is only up 14.33%, and this is since around May of 2020. So over the last 4 or so years now, this ETF has only returned somewhere around 3 or 4% every single year as far as price goes. And although, of course, with the dividend, that's not all that bad, it still isn't necessarily all that great considering you could have pretty much thrown a dart at the wall in the last 4 years, and you're probably going to be up substantially more than this. Now, a quick note on why this ETF has had some struggles over time to grow as far as ETF price. With ETFs that do have the cover call overlay, just like the JPMorgan Equity Premium Income ETF has, a lot of times when the market goes very bullish and things start, because that cover call overlay, the underlying holdings will be called away, so there isn't necessarily all that much upside. But during times in the market where things get volatile and things start to sell off, although the downside is somewhat protected by that cover call overlay, it's only going to help so much. Not to mention the fact that JEPI does have a smaller breakdown as far as technology, in the top sectors being only 19% technology. Other option income style ETFs like JEPQ, for example, that has 51% of the ETF exposed to technology, even with the cover call overlay, JEPQ has been an absolute rocket over the last year. But all in all, I think it's safe to say that, generally speaking, for an income-focused cover call style ETF, I think JEPI sort of gets a pass, at least because this ETF hasn't decayed, meaning that the ETF on the max time frame at least is not in the red like a lot of cover call option income style ETFs, and we all know exactly which ones we're talking about. Now, in hopes to figure out if JEPI is all hype or if this ETF is truly worth it, looking into JEPI's dividend over the max time frame. Now, because JEPI does have the strategy that it has, and because the way this fund earns money is through premiums, and premiums are going to be priced differently, depending exactly where volatility is pricing, the dividends are not going to be very consistent when it comes to JEPI or any other cover call style income style ETFs across the board, really. Now, that's not to say that there are some cover call option income style ETFs that do have more of a consistent dividend, but when it comes to JEPI and JEPQ, for example, the JPMorgan ETFs, they're going to pay pretty much a different amount every single month. But over time, if we look at all the dividends that have been paid over the past several years, around 4 years now, there's been times where volatility is very, very low in the market and premiums are very cheap. And because JEPI sells cover calls and earns premiums, that's going to definitely hurt the dividend yield, and it has substantially over the last year. So the ETF that I just added to my portfolio today, just a very small position, just to feel it out, is FEPI or FEPI, the Rex FANG Innovation Equity Premium Income ETF. Now, right here on the Rex Shares website, it says FEPI's objective is to own big tech, which I like because these names are higher beta, which means there's more potential for upside. But along with that, these names offer bigger premiums, which is perfect because FEPI's other objective is to write cover calls, which makes enhanced income potential. It says Rex FANG Innovation Equity Premium Income ETF, the fund investment objectives are capital appreciation and current income. Now, digging a little bit deeper into this income ETF, here's the fact sheet. It says the objective, like we said, is to combine big tech stock exposure and a potential for steady income in a covered call ETF. Now, some crazy stats about FEPI so far: distribution rate 25.20%. Now, the reason this distribution rate is likely this high is again because big tech offers juicy premiums, which means there's the potential to earn a ton of income if the market trades within your favor. It next says the approach is to own big tech. FEPI owns the 15 stocks from the sole active FANG Innovation Index. Plus, along with this, FEPI sells call options on these big tech stocks seeking to harness their volatility. And because these names are so volatile, because they move so much consistently, whether up or down, they're going to offer juicy premiums. Now, because of this, FEPI seeks to provide monthly distributions to investors with no K1, which is awesome. K1s are kind of annoying when it comes to tax time. And trust me, I own enterprise products, which does in fact make you file a K1. Now, benefits as big tech exposure, FEPI provides exposure to leading tech firms within the FANG Innovation Index, equally weighted providing a strategic approach. Now, potential income generation, FEPI aims to steady enhance income by selling out of the money call options, harnessing big tech's volatility while capping some of the potential stock gains. Now, also with this potential downside buffer, which is one of the main reasons on why I am such a big fan of covered calls, I don't mind limiting my upside if it means that I'm protected when the market turns sour. FEPI uses the covered call approach to counterbalance potential market declines, seeking to offer mitigation from price declines of these big tech stocks. Now, although this fund has been around since last year, and I definitely have heard about it, it really has taken me until today, honestly, to dig a little bit deeper into it, and I'm liking what I'm seeing so far. Now, the fund's inception date is as of October 11th last year. The primary exchange is Nasdaq. The gross expense ratio is 0.65%, so you are going to be paying a little bit to get exposure to this ETF, but because of the management, it makes sense. Net assets as of right now are 161 million, so relatively small compared to some of the other covered call funds like JEPQ, JEPI, or even SPYI. Now, like we said, distribution rate, which of course can change in the future, but as of right now, 25.2%, which is very impressive. Monthly distribution, which I love. And the top fund holdings, these are all names for the most part that I don't mind having exposure to. And I will also mention that some of these names specifically, I don't really have that much exposure to. So that's also one of the reasons I wanted to buy. I wanted to start buying some shares of FEPI just to get some more exposure to some of these names. Now, the top names are Micron Technologies, which we're all familiar with. We have AMD, we have Alphabet, Tesla, Intel, we have Amazon, Nvidia. Then there's Adobe, Salesforce, Microsoft, Palo Alto Networks. We got Netflix, Apple, and AMD. Now, before we look into FEPI's price performance, the dividends that were paid so far, and dig a little bit deeper into this ETF, I also clicked on the 19A/1 notice on the RexFang website. And this is also a very important aspect of this ETF, especially for those investors out there that are a little bit more conscious on how they're getting taxed on their holdings, how they're getting taxed on their dividends, distributions, etc. This notice provides shareholders an Innovation Equity Premium Income ETF with information regarding the portion of distribution paid on March 28th that is estimated to be made from net investment income, net realized capital gains, and return of capital. So this gives you a little bit of an idea on how things at least should be taxed when it comes to tax time. Now, this is just as of March, keep in mind, but net investment income, it looks like 0%. Net realized capital gains, 0%. It looks like return of capital is $1.19 or 100% or $5.91, and that's 100% total cumulative distributions year to date. Now, in this video specifically, I'm not going to go through exactly how all these are going to be taxed and different tax strategies, because that's for one a very individual thing that you need to figure out. But let's just say return of capital is very favorable for some investors looking to kick the can on the road. Now, without wasting any time, heading over to the JPMorgan website, which is who manages JEPQ, it says JPMorgan Nasdaq Equity Premium Income ETF. And JEPQ's overview says designed to provide current income while maintaining prospects for capital appreciation. That's one of my favorite things about JEPQ, even though it does offer a substantial dividend yield and it has been paying a consistent dividend on a monthly basis, which you're going to see later on in the video. This ETF also prospects for capital appreciation, which means, of course, even on top of the dividends, by owning this ETF, you could earn some money off of just the ETF price. It then says generates income through a combination of selling options and investing in U.S. large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. It then says seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index. But very important here, with less volatility. So by investing into companies within the Nasdaq 100 index, you are most likely going to see some growth potential, at least when these names do well. But even during times when some of these names might not perform all that well, you are going to have less volatility because, of course, this ETF has an option overlay. Next, digging into this portfolio, the amount of holdings, and the top 10 holdings. JEPQ's top holdings as of right now, around 8 or 9% of the ETF is currently Microsoft. Then we have a massive portion of Apple, Google, Amazon, Nvidia, and Meta. So it's no secret that these names, for example, are going to be higher beta, which means they're going to trade a little bit outside the lines of the general markets. But as you can see, when the market turns and starts to do well again, you can see JEPQ has definitely benefited from that. And with the overall strategy, this ETF is up 21%. not even including dividends year to date. But a very important aspect when it comes to investing into a higher yielding ETF, of course, is going to be exactly that, the dividends. Now, I started buying JEPQ over a year ago when this ETF was paying over 50 cents on a monthly basis, and keep in mind that was upwards of 10, 12, 14% yield at the time. But since then, the dividends have sort of gotten smaller and smaller for the most part, up until pretty much as of recently. The dividends were sub 40 cents on a monthly basis and now just right above it. And without taking up too much time and going too deep into it for this video, JEPQ is going to pay a different dividend amount on a monthly basis, and it's going to depend on how the portfolio, the underlying trades within that given time frame. But generally speaking, during times of heavier volatility, premiums from options are going to be inflated, which means JEPQ or other covered call ETFs could benefit from that. But during times like earlier this year, back in May, June, and July, when volatility was very, very low, you can see the dividends also corresponded to that. But honestly, even with the lower dividends as of recently, JEPQ still has over a 10% trailing 12-month dividend yield. And not to mention, once again, this ETF is up 21% year to date. So everything we went over so far paints a pretty rosy picture for JEPQ, but one of the main reasons on why this ETF is my favorite covered call ETF, or one of my favorite higher yielding ETFs across the entire market in general, is the fact that the holding breakdown is as follows. Technology makes up a majority of this ETF at 50.41%. Then we have a smaller portion of communication, consumer cyclical, healthcare, and consumer defensive. The top 5 breakdowns make up a majority of this ETF. So you might be asking yourself, well, what's so special about technology and why does JEPQ have so much of its overall holdings based in it? Well, the great thing about tech stocks in general is that they're known to potentially deliver significant growth. With technology advancements and innovations that are continuously going on, there is crazy opportunity in the market to make a lot of money and some major moves in the technology sector. Now, with the JEPQ ETF being so heavily invested in technology, it is definitely going to have a much higher beta. Now, market beta, also known as systemic risk or equity beta, is a measure of a stock or portfolio's sensitivity to the overall market movements. So beta is a commonly used term as far as risk indicator. A beta of 1 indicates that the asset or portfolio tends to move in line with the overall market. If the market increases by 1%, the asset or portfolio is expected to also increase around 1%. Now, with JEPQ's holdings being majority technology, that means that this ETF is going to have a much higher beta, again, compared to something like JEPI. Now, this can definitely be a good thing, of course, when the market moves up. But when the market moves down, once again, something with a higher beta than 1 is also going to move down more significantly. So if you combine the cover call strategy, but also the underlying holdings, the fact that a lot of these individual stocks are higher beta and do have the potential to move, especially when the market does well. But with that, of course, keep in mind there is that cover call overlay, which means some of the potential upside will be capped, but also volatility will be slowed because of that. For those reasons, this ETF is one of my favorites because I feel like it sort of offers everything all in one that a lot of other cover call ETFs are sort of lacking. It offers an underlying basket of holdings that do have growth potential, but a cover call strategy that can sort of be used as a backstop if things turn for the worse. And a system, generally speaking, where volatility means higher dividends. And with this ETF pretty much offers all in one, which is why I've been personally buying it so heavily over the last year. Now, before we dig into my personal portfolio when it comes to JEPQ and some of the dividends I've been paid over the last year from JEPQ. Looking at JEPQ's total return year to date, this is dividends plus price return included. This ETF is up 32.59% over the last 325 days. Now, I can't speak for everyone, but I'm honestly pretty excited about an 8, 9, 10, 12% return on a yearly basis. So of course, for me, 32% total return year-to-date performance is honestly amazing. And although it's hard to know what's going to happen in the future for JEPQ, I think the future looks pretty bright, especially for those investors that aren't necessarily trying to get rich overnight. Now, the last thing I want to share with you guys is my personal portfolio when it comes to JEPQ, how many shares I have across my portfolios, and even some dividends that I was paid throughout the last year. Now, across all my portfolios as of this moment, I think I have 500 or 600 shares of JEPQ, and I will definitely be buying more on the next pullback. And as you can see, over the last year, I've been buying more and more shares like crazy, considering I was only getting paid in this specific portfolio, for example, around $20 or $30 on a monthly basis. And then as of recently, as I bought more and more shares, now I'm up to somewhere of around $125 to $130 in dividends on a monthly basis from JEPQ ETF, and that's only one portfolio. I do in fact have this ETF spread out across multiple portfolios. Now, like I said, I will definitely be buying more JEPQ on the next pullback, hopefully somewhere around $45 per share. But until then, I'm sitting pretty good on my shares of JEPQ. I'm up quite a bit off my average cost. And until then, I'm just patiently sitting back and earning dividends along the way. Because of JEPQ's potential for massive capital appreciation in the future, because of the higher beta, high quality basket of holdings that this ETF has, and on top of that, the significant, consistent dividend that JEPQ has paid since inception, this ETF for me personally is a perfect staple to have in my long-term dividend growth portfolio. Now, if an investor, not like myself, is not all that interested in getting paid on a monthly basis, and wants to invest into an ETF with higher overall growth potential, well then JEPQ might not be the right investment vehicle for you. But for the investors out there, like myself personally, that are looking for a high quality ETF with rock solid holdings that pays a great dividend on a monthly basis and also has the potential for some massive upside, JEPQ is definitely an ETF worth looking into. So now that we talked about more or less every single higher yielding ETF that I would consider high quality, I lastly want to hear from you guys down below. Out of every single one of these, which is your favorite and why? Drop the ticker symbol and let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.